Welcome back to another stock market open. Today, it looks like the stock market is a little happy that we have solved our RSI problem from yesterday. Apparently, our RSI problem from yesterday has passed. Apparently, we are now sitting at slightly green on the indices across the board here. We've got 42 bips on Dow, 52 on S&P, and 68, almost 69 on the NASDAQ. We've got bonds still sitting at that 3.864 level. Now, what's interesting here is we saw a movement down here, in part due to Mr. Hooker yesterday. You head on over to ehack.com. You'll see exactly that. You'll jump on over here to the green box. You're always looking for green if we're going Fed. What we found with the green box over here was that Mr. Philly Fed president here suggested, who's not a voting member next year, keep that in mind, he's not voting next year, suggested that the Fed should reduce interest rates, though not immediately, hold rates steady, but we should reduce, because it's important to reduce, because if you don't reduce, then what happens? Well, if you don't reduce, then you end up tightening more, and that's what they're trying to avoid. So we threw that on eHack yesterday. If you haven't seen that yet, make sure to take a peek at that. Big thing today, really just over the next few minutes, and then we'll kind of see how the day goes, is going to be unemployment claims. So we're going to be getting brand new data on unemployment claims. We're going to be looking at the Q3 annualized GDP figures as well. This is like the third estimate. It's kind of annoying how they do this, but you've got three estimates that go into GDP. There's the initial, the first revision, second revision. So this is now going to be the third and final revision for Q3. And then we can actually be curious about what's going on with our Q4, which I think will be a lot more interesting, what our Q4 data will be. Currently, the Atlanta Fed sees Q4 GDP. You won't believe it, but remember how Q4 GDP kind of dropped down there to like 1.2% for a moment? The latest estimate is out. 2.7%. It's gone right back up. Look at that little dipply doodlaw there we had just for a tiny, brief little moment. Atlanta Fed GDP now estimate dropping to just about 1.2% there for a moment, and teetered around to the left and right. And then shot right back up now to about 2.7% on the Atlanta Fed real GDP read. All right, we are just now about 1 minute away from this initial claims and GDP report, as well as Philly Fed business outlook. Not some of the most major catalysts in terms of data points, but something we'll definitely be watching. So as we watch this, we'll also be watching what comes across from the suits. What are the suits seeing today? Right now, we've got some discussion over short-term risks to Treasury positioning, suggesting despite the massive rally we've seen in Treasuries over the past few months, trader positioning shows that the bias is still pretty skewed. Options on longer maturity treasuries show that outstanding open positions will benefit from a rally, 1.7 times as much as those that offer downside protection. Interesting. All right, here we go. GDP annualized, as expected, comes in at 5.2. Initial claims, weaker than expected. That's good. Not super weak, though. 205. Philly Fed business outlook conditions comes in way weaker than expected at 10.5 versus the 3.0. And continuing claims come in lower than expected at 1865 versus 1880. So consider that for a moment. You've got the Philly Fed numbers coming in a week. However, those continuing claims numbers suggesting the economy is maybe a little bit stronger than forecasters had estimated, but only by a slight bit. What I wrote on eHack is that we really wanted this to come in relatively close. We don't want to come in super low with unemployment claims because we don't want to suggest that the Fed's got to do more, raise rates. This is just a slight little hair under. It's an anti-recessionary style argument. Let's listen here to tell us, see if we talk about Philly Fed at all. Of course, Q3 GDP we heard, and I'll grab their surveys. Okay, let's see. Not pulling audio from them, no problem. Well, it is a problem. I will go find out what the problem is there and fix it. But anyway, Philly Fed, I mean, so far they're just going to repeat what we just heard. Philly Fed. What we're looking with the Philly Fed is Philly Fed Business Outlook. Take a shot every time you say Philly Fed. It just rolls off the tongue. But anyway, we've got the latest update here. Let me see if I can. Oh, there we go.
A little bit.
There we go. Do I have it?
Very close to our last look. 1,865,000.
Talk Philly Fed.
Pretty much a push with last month, and it really does underscore that the last time we were above 1.9 million was the second week in November, and we haven't been anywhere really near it since. And that particular number was the highest going back to November of 21. So you could see 1.9 remains elusive, and it's a very important psychological area to pay attention to. Now, let's look at Philly Fed, shall we? What's interesting here, Joe, is 14 of the last 16 months have been negative. This year in particular, 10 out of 11 negative. The only positive month was August, and it's still negative, minus 10.5, which means 11 of 12, a 10.5. That is not a very good number. The last time we were anywhere near that number, of course, was just at minus 13 in September. But what's interesting here is that if you look at the 12 that we had in August, the only positive number, you had to go all the way back to April of last year to find another number that was higher. So Philly Fed remains under significant pressure. It is a December, the most forward-looking number that we have. Interest rates, well, they were pretty volatile. We ticked down to 384, and we're back up to 386. All yields are slightly higher on the session. And consider this. Here we are at 386 in a 10-year. Where did it close? Where was it on the last trading day at 22? 388, darn close. And I heard from some of my sources you were discussing bond yields. Yes, bond yields are far and away have made the most progress if you're calling a rally pushing yields down through the closing levels of 22. They closed 22, 10-year bond in Europe at 257. They're clocking right now around 196. That is a big move. Joe, back to you.
Yeah, well, I don't know where he's getting the idea that bond yields are up right now, but I don't know, maybe the tape is a little different for them. But I'm actually getting the 10-year dropping, which is interesting. We just a couple minutes ago here, we had 3.86 on the 10-year. Now we're down to 3.845. So that could be because we're getting these jobless claims roughly in line with expectations, that the economy is not super strong, not super weak, kind of right around there at expectations when it comes to jobs, which appears to be the biggest thing the Federal Reserve is highlighting right now. And it could also be because we've got the Federal Reserve that's wanting to make sure they don't over-tighten. It could be the Philly Fed survey that ended up with a little bit of a softer read here that gave us a drop in yield. But either way, Bloomberg's running the headline here that jobless claims rise 2,000, but the last jobless claims numbers from last week were actually revised down 2,000. So you pretty much got nothing. So that is not terribly exciting. It's mostly in line with expectations, the exception of Philly Fed. Let me see if they say anything else that's interesting.
In about the next 8 to 12 months, and then all of a sudden, all we hear is whispers about lowering rates. Powell comes out at the last press conference and says, yeah, but the real story here is we're talking about easing. So this good cop, bad cop, I mean, that's my take on it. People can have their heads explode because of the obvious purity of the Federal Reserve, but there is a certain reality to life. If you look at how things are shaping up and try to fit a logic to it, that makes some sense.
Yeah, and even what Warsh said yesterday, just in a nutshell, was, So you do believe MMT works, Jay Powell? Great. So we're back to that. We're back to, so there's no problem. 33 trillion. What me worry? Alfred E. Newman. Let's get to Joe Lavorgna, chief economist, SMBC Nikko Securities America, former chief economist at the White House.
All right, let's pull off here for a moment. So, okay, yes, let's take a peek here. We've got a lot to talk about. It is. Well, another classic trading day here. We've got, I think the big thing that I really want to pay attention today is to see how the market moves following some of this data. Right now, if we jump on over here, we have the market moving up on the Qs. You've got Tesla up 1.9, the Nasdaq's up 1%. You've got the S&P 500. Let's get the SPY over here. There we go. The SPX won't show you futures, but if you go to SPY, you'll see it up 71 bips right here. So interesting reaction, positive reaction to the data. It seemed like what we kind of talked about yesterday is roughly what we got, which is, hey, if we get something roughly at expectations, then we should be getting a pretty neutral move here. So I want to review, let's see here, we've got a piece I want to cover here from Apollo 2024 Economic and Capital Markets Outlook. We're going to get this up, and then we're going to jump into some more of our goodies here. So as far as the Wall Street Journal, I thought yesterday something that Biden covered. Actually, no, not yesterday. They just posted this. I posted at midnight. I was up at midnight too, so I saw this. But Biden administration exploring raising tariffs on Chinese EVs. Basically trying to tax more Chinese goods, more including Chinese electric vehicles. Long divided over Trump-era policies on tariffs for Chinese goods, blah, blah, blah. EVs from China are already subject to a 25% tariff. There's an idea of potentially taxing them even more to help out American vehicle companies get a little bit more of a head start in manufacturing EVs. But then again, the only one that's really pulling it off is Tesla. Right now, the current focus of the Inflation Reduction Act has been taxing batteries and Chinese-made batteries more. It's actually one of the reasons why the Tesla Model 3 may lose its entire $7,500 tax credit as we go into next year. That's encouraging a lot of people to consider, if they wanted to buy a Tesla, grab it now, because apparently if you were looking at a Model 3, you're not getting the $7,500 tax credit at all. If you go into Q1, at least that's the current guidance. They usually always undo that guidance, and they end up loosening those restrictions. But we'll see. We'll see if that ends up driving any kind of marketing push for Tesla in the meantime, especially since you're faced with this idea that starting January 1, you could get the $7,500 tax credit immediately for vehicles that are eligible rather than waiting for your tax return. That these could be sort of counterbalancing items here. Of course, then you wonder, what would you rather have in the long term? No tax credit on the Model 3 or a tax credit on the Model 3? I would guess you'd want a tax credit on the Model 3. Anyway, then we've got GDP data providing an early Christmas gift on inflation suggested here. The third revision GDP figure is pretty old news by now. Yep. But there was a dovish slant to its core inflation reading, and it was revised lower to 2% annualized. Ooh, really? See, I missed that. Maybe that would explain why we saw the movement then. See, core PCE. Oh, yeah. Core PCE price index. The third revision of GDP just pulled core PCE prices quarter over quarter down from 2.3% to 2.0. Now that's really interesting. So what you're getting is on the third revision, while everything else looked like it matched GDP, annualized quarter over quarter or otherwise, all of a sudden we get this shift down in core PCE prices. Fascinating. Let's see if they're touching on that here.
Concern about politics is going to lead the Fed in the wrong direction. I also think that the Fed should be cutting aggressively. And we need to talk about why. So earlier I heard Rick talk about normalization. It's not just normalizing prices in the economy. The Fed has a responsibility to normalize interest rates over the long run. And it's actually part of their statutory mandate, Rick. They have a triple mandate. So the Fed
I never
is supposed
said anything
to have
about normalizing. Never used the word today. Never said normalizing. Didn't say.
The Fed has a sense of what the long-term normal appropriate interest rate is for economic growth and stability. And
who knows?
they
They've been
really
fooling around with interest
deviated
rates.
from that. Excuse me, I'd like to
They've been fooling
finish.
around with them for 12
Rick,
years.
I'd really like to finish. They absolutely deviated from that really, really dramatically over the past couple of years through their very, very aggressive rate hiking campaign. If they're going to treat inflation and data symmetrically, they need to be thinking about having a similarly aggressive campaign of rate cuts in order to bring us back down to a normal and appropriate level of interest rates that don't have all of these knock-on bad effects, like stopping housing construction at a time when house prices are driven by a supply shortage, like cutting off investment in the kinds of things that will
How does the Fed know where rates are supposed to be? Can you tell me that? How does the Fed know where rates are supposed to be? Just curious. I thought that was something the markets did. Like, how do they know? Do they have
the markets, Rick.
December 30th, rates should be here.
The markets, incredibly, Rick, the markets want the Fed to cut much more than the Fed is indicating. So what are you saying? Is the market's political, Rick? The markets want six rate cuts this year. The Fed is dialed in 3 as an average.
The market's handicapped. Gee, our balance sheet's all the way down to $8 trillion. Where would it be if we put the $8 trillion back where they were supposed to be? Or the parking lot of reverse repos? Or all the games central bankers have played? There's no way to know where interest rates are supposed to be.
How can the markets handicap, Rick, when every Fed official has come on our air, every location, and they have said, I'm just going to finish here, Rick, for a second. I'll just finish. I have a very quick sentence here, which is, how does the markets handicap that the Fed is going to do more when every Fed official we've had on, from the Dovius Goolsbee to John Williams in the center, saying the market went too far? So I'm a little confused as to what you think the market's making its own decisions in part.
I can't help you.
I'm not saying it's divorced from the Fed.
I'm going to get yelled at for not moderating, and I can't secretly let everyone know I love this, so I got to let Joe Livorno know.
Yeah, I disagree with what Steve said. I'm not sure the presidents actually fully reflect the situation in the board. It's not as if, I know the New York Fed, for example, and the board are very close, but to me, this decision about the pivot was really a board decision.
How many of these guys?
Steve, let me finish. Steve,
how many of these guys are Trump officials?
Take a break. Stop. Please let me finish. I'm not on every day like you are. The thing is, the Fed,
me neither.
The board, I think, made a decision to pivot. I do believe politics are part of it. We do have 4 Biden appointees that are there. And if it wasn't politics, then their forecast should have shown a bigger reduction in inflation. And it wasn't there. So the fact that the presidents aren't on board with the board doesn't mean that it's necessarily all this kumbaya moment and everybody's in agreement. I don't believe that to be the case.
I did think, Rick, and Steve and Becky and Kitty, we had Roger Ferguson on so many times. This is a quick pivot. Roger's on every 2 weeks. He's on every 2 weeks. He has not had a chance to change his very hawkish stance, and we're already factoring into. Kitty, I had one question for you. Are you an?
Well, they are so fussy. Like, our Rick guy here in the middle is so fussy.
You didn't talk.
I think his shorts started losing because everything went green here.
We were at 0, and you said this horrible rate rising cycle that they've been in. That was barely scratching the surface of the easing they've done for the past 12 years.
So actually, that's a really good point. Thinking about the idea that there is a long-term stable normal rate of interest doesn't include being at 0 forever. But the Fed's rate hiking campaign was really aggressively fast. And there's a big difference between 0 and 2.5. And there's a big difference between 2.5 and 5.5. And if you look at the Fed's own projections for quite some time, they have had interest rates falling eventually back to around a 2.5% rate. The question is how quickly you move there. And on why I've been calling for rate cuts and, the question of the relationship between what the Fed's doing and inflation, we've really seen the data is very clear at this point that we had supply shock driven inflation, which isn't at all surprising given that we just had an unprecedented global pandemic event. And that took some time to work its way through. And as it did, we saw price increases start to fall, right? And that's what many of us expected to see. That was not primarily driven by the Fed's rate increases. And I think the Fed's starting to think a little bit harder about the real problems their rates are causing.
Yeah, we got to go, though, Steve. I'm afraid to.
I just think we need to make one point, which is that 3 of the Federal Reserve governors, all of whom voted with the current policy, were appointed by Trump, including the chair. So the idea that there's some Biden or Democratic majority out there is just not accurate.
Well,
although the only thing I would say, Steve, just getting back to what Joe said.
Joe was there when these guys were appointed.
Yeah, but Joe wasn't saying it was the Democrats trying to do this. It was almost the Fed trying to not look political, which I don't, just saying we don't want to be starting a campaign in an election season because it looks like we're political. Maybe they feel like this is what they have to have happen. It's not the same as like some Democrat conspiracy.
You know what? It's hard to make jobless claims interesting. And even our old producer, Max Myers, is saying
they have managed to do it.
Best jobless claims ever, bar none. And if we show those 5 again, I mean, look at Livornia's outfit. You're Donald Trump. I mean, you just are. You got the red tie.
You're missing his pants.
Yeah,
he's got Christmas pants on.
Kitty, you represent that side well. And then we got Rick and Steve. I really liked it. I didn't have to do anything. Thank you, Joe, Kitty, Rick. We'll be right. And Steve, Sparkbox will be right back.
Yeah. Wow. Okay. So that was really interesting. That was intense. I found this. That same guy. He's always coming out yelling. Rick Santelli. Every time the data starts coming in. Like suggesting that inflation could end up being transitory, he freaks out. And one of the reasons he freaks out is because he's frustrated that America can get away with basically printing trillions of dollars and then us not actually go into some kind of like a depression that's going to mop up all of this money printing. Like, I think there are a group of Austrian economists who absolutely despise Keynesians. Keynesians are when the economy's doing poorly, we print money and we try to prop things up. When the economy's doing really, really well, will restrict at that point, right? So your Keynesian idea is how can we print and potentially finance our deficits when we need to, and it'll all be okay. The Austrian people, and I'm way oversimplifying, right? Austrian is much more, no, our money should be, our money should mean something. It should be backed by gold we shouldn't just resort to the money printer and the creation of money out of thin air. And so on one hand, that makes a fair point. Like, we probably shouldn't just always rely on the money printer. I agree. I think eventually that's going to lead the dollar to be worthless and collapse. But the reality is, in the short term, kind of like stocks. You know how kind of in stocks you're like, I think this trade is going to work. You've got a really good trade idea, right? Really, really good trade idea. The fundamentals are right. Everything's lining up, everything. And the stock just goes in the opposite direction. It's like a short term, it doesn't have to make sense. For America, I actually kind of think we might be able to pull that off for like another 100 years or whatever, where we do the kind of funny money printing and we don't actually have inflation. And that makes people really upset, because when we look at the traditional Austrian economics, we look and we say, look, inflation is the expansion of the money supply. The money supply expanded. How do we not have the data coming in worse? Why is the market going green? It's supposed to be going down. Well, because inflation, every time we get a new report, kind of takes on the idea of, prices actually might be coming down. And if we overdo it, well, then we risk creating an unemployment led recession, which is really bad. So this is a situation where a lot of folks are maybe dare we say rightfully frustrated. But I don't know that being so angry to where you're cutting off the guests at CNBC, well, it made great entertainment. I mean, I'll tell you, like, we haven't watched a long stint like that of CNBC in a freaking while, okay? Wow. I have to say, I'm not, disappointed in the entertainment we got, but I guess I'm a little disappointed in the discussion. It just seemed like it went a little haywire there. But anyway, I don't think they're going to be bringing him back here for a moment, no?
Of the freight rates.
No, we're going to talk about freight rates, which we've already kind of touched on, things like that. Let's, jump for a moment and see if we could get Doomberg. But we'll see what we have here. Interest rates higher than GDP. Well, and maybe rates right now. Yeah, but I'm just looking at some of the comments here. Modern monetary theory, yeah, and there is also that expectation that maybe this is all to prop up Biden, whatever. Let's listen in right over here. Let's listen to Rogoff.
Yeah, as I said, some of that single name stuff I just mentioned where we miss earnings and you're really hit means I don't think you can categorically go that way. However, if we look at, like, say, the high grade market today and you look at where single A bonds are versus where triple B bonds are, those triple B bonds are extremely wide to single A bonds for sort of the level of risk in the market today. So I do think you have to go down in quality there. I think if you looked at the high yield market, probably more of a barbelled approach is appropriate there, because of the idiosyncrasies when you get to really risky high yield names. But you have to do
some big old words, man. What's your point, bro? Euphoria is justified right now? What?
24 look ahead. And the first line is that the rally into year end will limit performance from spreads in 2024. And we've been talking about how very tight spreads are. And against that backdrop, is 2024 going to be more about, just clipping coupons, enjoying those high yields versus actual spread compression?
I think so. We got this Christmas present of some extra return in 2023, but it does have to come from somewhere. And I think it comes from next year. And really, and look, there's always two components to returns when you're talking about fixed income and a spread product. You're talking about spreads and rates. And both of them have gone lower recently. And that's not traditionally, if you think back about the history of the fixed income markets, that's not necessarily traditionally how it goes. When both of those come lower, I think you probably wind up looking at, maybe even a slightly lower than coupon type return. Nothing dramatic, but slightly lower than coupon type return as we look at 2024.
Especially because of what we just heard from Steve Ricciuto. Are you concerned that because of the euphoria that we've been talking about, there is going to be a sort of second leg of inflation, that the Fed's going to actually see some of their verbiage work against
I don't think so. We'll see what he says, though.
A loosening in financial conditions leading to a stickier inflation that leads to higher yields. Is that something you're gaming out?
Not entirely. I think that higher yields is something we are thinking about. I don't think we think it's because we see another pickup of inflation. I think, do we not see inflation come down as quickly as some in the market are thinking? Yes. And then we look at the rates market today, and we don't really see any term premium in it with what we've seen in the last month. And by the way, if the economy is going to hold up better, that might mean the neutral rate should be higher. And as a result, there should be some term premium, actually. And so when you put that all together, I don't even think you need inflation to pick back up as much as not decelerate as quickly as some are forecasting. And then, rates don't come down. And once again, that's not a tailwind like we've had recently for returns in the market, and maybe even a tiny bit of a headwind.
I want to end where we began. As someone who has to come up with a year-ahead outlook, how much harder is it for you to do so when there is such a huge transformation going on in the credit market, with such a huge portion of it going to the private market?
Yeah, all right. So let's take a listen over here. So I thought this was interesting. That is a very common thesis, by the way. A very, very common thesis that, hey, her question, right? That We're gonna end up getting kicked in the booty because as soon as we get a looser Fed, we're going to get inflation. We've covered that a lot. That I personally don't think that's like it. I recognize it though that it is a bare thesis, and I'm certainly not gonna close my eyes or cover up my ears over higher inflation data as it comes in. But we're not seeing that right now. What we are seeing is a still inverted yield curve. I think that's probably one of your best bear arguments right now is the fact that you're still inverted. You're negative 48.7 bips on the yield curve. And, if anything, we're still rotating down. So here, I'll go ahead and pull up the chart in just a moment. It's not the most ideal. And we'd like to see a re-inversion with a, bull steepening. But right now what we're getting is well, quite frankly, since about the Fed meeting, we've just been coming straight down on the yield curve, which is interesting because we're getting. Look, I mean, the 10-year right now is what, 3.84. So what it really means is the 10-year is essentially falling faster than the 2-year is falling on average here. So that's what's leading to a still inverted yield curve. Here's a picture of what that looks like right now. This right here, this line right here was November 1st. So here's your Fed meeting, and then you've come basically straight down into inverted yield curve territory. We don't necessarily want to be in more inverted yield curve territory because the more you're in inverted yield curve territory, the more you got bears who suggest, don't worry. Take all the euphoria you want. The price is still going to have to get paid. Just wait for the bill to come due for an inverted yield curve. It's not unreasonable to think that problems could come out of this. I agree with that. So I want to make it clear. I realize the inverted yield curve isn't great. The only time we've really dodged the bullet on an inverted yield curve, and that's one of sort of the scary lingering effects. The only time we've dodged a bullet on an inverted yield curve not causing a recession was like 1994, and we went inverted by like nothing. I think it was somewhere. In fact, I'll go look back at it. But I want to say, if I remember correctly, it was like 10 basis points inverted or something very, very nominal. The zero. Oh yeah. Okay, yeah. It was not mid-90s. It was actually 98. In 94, you got down to 7.4 bips. So 7.4 bips in 94, and in 98, you got down to negative 19 basis points. And then, of course, there people say, oh, well, of course. I mean, then we had the dot-com bubble, but technically we didn't go into recession until 21. So you had like a 3-year window. And then the question comes like, okay, well, we're always probably like 3 to 7 years away from a recession, right? So it's really interesting. Really, it's going to be very interesting to see what ends up playing out. But there are arguments to be made on both sides. I just find the bear arguments are weakening. We're getting less and less and less of those available to consider or be concerned about, or however we want to look at it. So anyway, I wanted to get into this piece right here, and we'll hop around and kind of see what else is going on out there. This right here is the Apollo 2024 Economic and Capital Markets Outlook. Just had somebody send this over to me. I think this is a very interesting one. The members of the FOMC pivoted to a more dovish stance since their last meeting. We already know that. That is very, very clear that they did. What I'm going to be looking for in this piece is where are we going in terms of their forecast? Do they think it's unnecessary, or do they think they're in the right way? They suggest that the Fed pivot underscores what they call a rapidly shifting outlook for both growth and inflation. They suggest that going into the new year, we still see upside risks to inflation and downside risks to growth. That, by the way, we're going to see for quite a while. This GDP revision today, and I can't believe I missed it when the data first came out, was wild. Because the GDP revision really told us, hey, look, all of a sudden, you can actually have a third revision support a rally in markets. And so people were like, wait, what? That was really interesting to me. That I personally wasn't expecting it. Maybe that's why I missed it, because like, nothing's going to change. We got our headline number, then like nothing's going to change. The fact that they revised GDP's inflation estimate down, pretty wild. Okay, so then we've got going into the new year, we saw that. Despite signaled Fed rate cuts in 2024, we expect interest rates to stay higher for longer. Wow, okay, so this group here is convinced we're still going to get more of this higher for longer. We arrived at our thesis through a combination of cyclical and secular drivers, including still tight Fed monetary policy, higher borrowing needs by the Treasury. That's an interesting argument. The more the Federal Reserve has to print money on behalf of basically the Treasury Department, or the Treasury Department just straight up issues more bonds, the more bond supply you have, more bond supply can lower prices and increase yields. So really you need people not just going from stocks to bonds, but you need more and more and more to constantly keep feeding the debt of basically the spending that our government does. Now that's probably in part why you see somebody so upset like what we saw on CNBC, is because you've got, how do we keep financing all of this debt? It has to stop. And that sentiment, very fair sentiment. But I still maintain that I think there's a high likelihood that we're going to be able to, at least through the next few cycles. Two major factors driving consumer spending, largely unrelated to current Fed policies. Households are running out of excess savings and student loan payments are restarting. The combination of these two dynamics increases the odds of a meaningful slowdown in consumer expenditures. Okay, very well. Then we've got, we see many signs that Fed rate hikes are working to cool off the economy. Consumers are already feeling the pinch. That's true, and it's one of the reasons I've started to push a little bit towards what we have with the chip sector and maintaining in chips. Actually, we saw Micron's numbers yesterday. Let's see how they're moving in the morning here. But Micron's numbers yesterday weren't that bad. They increased their forecast about 5%. And a lot of people saw Micron as a tool for leading into enthusiasm continuing in the space of the chips sector. And so a lot of people pretty excited here that we could end up getting a continued rally in server sectors. Keep in mind that Micron is mostly a memory provider, but they do also provide memory for servers. So I touched on them. I broke theirs down. If you go to ehack.com, just type in Micron, you'll see it here. Beat by 5%. And I wrote a little reminder here of what they are. They deliver a rich portfolio of high-performance DRAM, NAND, and NOR memory and storage products. NAND, for example, is high-capacity, low-cost storage. They use them in like iPhones. And then, of course, you've got DRAM, which is just a typical kind of memory stick that you find in many of your computers. At least my understanding. I'm not the best with understanding all these chips. I realize I have limitations here. But for me, I don't generally like those kind of products because I see them as having less of a moat. Like I see an NVIDIA chip having substantially more of a moat than a memory stick product. But hey, you know what? Somebody's got to make it. So thank you. So anyway, okay, good. So let's keep going over here. Okay. So what do we have here? Two major factors driving consumer spending are largely unrelated to current Fed policy. Households are running out of excess savings and student loan payments are restarting. Combination of these two dynamics increases the odds of a meaningful slowdown in consumer expenditures. We see many signs that the Fed rate hikes are working to cool off the economy. Consumers are already feeling the pinch with increased delinquencies in both credit and we've got credit card debt and auto loans. That's true. We are seeing a good chunk of an increase in delinquencies. In fact, let's go pull that really quick. So we go to St. Louis Fred and we go to delinquencies on credit cards. Micron clearly said on their report that they're benefiting from the government CHIPS Act and stimulus. Oh, of course. I mean, they all are, right? Like, of course. Absolutely. All of them are, and all of them should. Like, consider what you have with Here, we'll pop over this for a moment. Consider what you have with Intel's manufacturing abilities that are heavily reliant right now on subsidies from the U.S. government. I mean, all of them are relying on subsidies, and it's not necessarily a bad thing. I actually kind of look at it and say, like, oh, maybe it's a good thing. Like, it allows us to separate from China. That's the way to look at the good thing. And then obviously we can take that information and then make the investments around it. So, like, that bill passed, and then this was last year. What was it, like September or August? The Inflation Reduction Act passed, and then I decided, chips are probably in a deep, dark recession right now. I'm going to plow into these puppies, which I did towards the end of the year. That ended up being a good move. One of the ones that I'm heavily weighted to that hasn't moved as well as like chips or some of these other sectors, frankly, Tesla. Like, Tesla's really been lagging behind. But anyway, who knows exactly why. I think it'll end up rubber banding up, but that always takes time. So what we have here, though, is you're right, and so are they over here. If we look at delinquency rates on credit card loans, all commercial banks, we are now sitting at 2.98%. That's higher than the highest point of the decade prior to, well, roughly the decade prior, the low parts here. What would that be? It'd be about the decade, actually. Almost. Higher than, wait, can I say decade? Q3 2023, 2.9. Q3. I can. Yeah. It's higher than the entire decade before the pandemic. That's wild. So consider that for a moment. Credit card delinquencies have broken out, and obviously they're trending up. Like, it's not like we're getting like this small little boop-de-doop-de move up here, right? That's not what we're getting at all. What we're actually seeing is a movement that's pretty rapid up. And it's not just a normalization to the prior trend, it's now blowing past the prior levels. So this idea of blowing past the prior levels is something that, people are like, wait a second here, is this sustainable? Well, no, probably not. Especially since we're likely going to kind of see this tick, 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 up and away. And we might end up, in something like an early 2000s or whatever. So yeah, the consumers' credit card, problems are expanding, and that's unfortunate. So that is going to be something to pay attention to. Delinquency rate on credit cards, higher than what we've seen in the past decade. Yep. Pretty wild. Okay, continuing over here. So finally, bank loan growth has been sharply slowing in recent months. Yep, no kidding. Despite the Fed's aggressive tightening campaign, inflation remains above the central bank's 2% target. We've long argued that rates will stay higher and for longer than the market expects. But if above target inflation persists, they may go higher yet. I don't know. And this is where I make this argument, and I make it all the time. I think people forget, and I don't know if it's just because they're not paying attention to it or they forget that the Fed's written policy is very, very clear. The Fed's written policy is FATE, flexible average inflation targeting. And that was not even a policy that they just sort of engineered during COVID. They actually, I'm pretty sure they came up with FATE, if I remember correctly. They came up with FATE before, and it was like in 2019. Let me look at it here. Flexible average inflation targeting, Federal Reserve policy. Flexible average inflation targeting, so... commentary announcing the switch. Oh, nope. It was August 2020. Wow, interesting. That is very interesting. The commentary examines the response of longer-run policy expectations to the FOMC's August 2020 announcement to a flexible average inflation targeting regime. The data indicate an upward shift in the lower end, below 2%, of a distribution of inflation expectations and stronger anchoring of expectations around 2% following the announcement. Evidence is consistent with the intended effects of the change in monetary policy framework. In other words, when they announced the policy, they saw inflation break-evens move up to basically bounce closer to around 2%. I didn't actually know that. That's really interesting, because here what they're saying is hey, like as soon as we announced the policy, we started seeing break-evens go up a little higher. Now that's really fascinating because I remember when they came out with, or when Jerome Powell started talking about inflation expectations over this last 2-year cycle, and what we got was a lot of concern over, hey, we want inflation expectations back to around 2%. And I've been very curious as to why they haven't broken through 2%, like lower than 2%. And I wonder if that's why. I wonder if that's why we are seeing these inflation expectations sit above the levels that that we'd previously gone to. Like here, let me explain that a little bit better just by showing you a picture. So I'm going to go to the 5-year break here. Let's pull this up. Okay, 5-year break even. If I go all the way out, those stinkers, maybe they knew. Maybe they knew they were about to cause a lot of inflation. And they came out with flexible average inflation targeting. Wow, after the pandemic, you stinkers. Yeah, that is so interesting. Okay, hold on. So let's pull this up here. Okay, now we have, I'm going to give you like a 13-year example here of what the, what's it called? 5-year break even looks like as soon as it sinks over. Come on, baby. Okay, it does this sometimes. Whatever. The point is, while I wait for it to pop up, the point is, in the 10 years prior, did I not take a screenshot? Maybe I didn't take a screenshot. Okay, there we go. In the 10 years prior, we have the inflation target, the 5-year break even. I would say the 5-year break even was averaging about 1.6%. And it was volatile, but it had not really been above 2%, with the exception of a tiny little bit in 2014, a tiny bit in 2017, and then a chunk of 2018. That's it. Outside of those little chunks, you didn't actually have the 5-year break even over 2%. Now we can't get under 2%. And I wonder if that's because of flexible average inflation targeting. How interesting. That is a really interesting policy. And I did not know they made that change. But again, I do think that people have almost heavily forgotten that the Fed has this policy. And it's going to skew their understanding, I think, of the Fed's goals. Because here, like you say, despite the Fed's aggressive tightening campaign, inflation remains well above the Fed's 2%. We've long argued that rates will stay higher than longer because basically we got to get back to 2%. Well, no, we don't, right? And I think that's what they miss. It's like, no, you do not have to go above 2% again. Oops. Or get back to 2%. You just have to average it out with the last decade. Boy, when they pull that genie out of the bottle, when people start asking, nobody's asked them, right? Like in the press conferences, if I could go to the press conferences, I would love to. Although maybe, should we ask the Fed, right? Because if you ask the Fed, do you potentially take away their genie in the bottle, right? I don't know if that's the best analogy, but are you basically taking away their magic trick? You're spoiling their magic trick that they're gonna pull in 2 years when the bears are like, how come we're at 2.3% inflation? You told us we were gonna go to 2%, and then they pull it out. You go, well, we actually disclosed this policy about the flexible average, and then people are gonna go, what the hell? Why didn't we think about that? Well, you were not paying attention to the Fed as much as you should have. Anyway. So all that said, we do not entirely discount the possibility of an upside economic surprise. Idiosyncratic economy has defied consensus predictions for some time now. That's also true. We should have been in a recession, right? I even thought for a while there we were going to go into a recession. So fully transparent about that. In January of 2022, I'm like, wait a minute. We might be walking right into a recession. Oh, man. So obviously, that didn't end up happening. But you have to remember this, 85% of economists said we were going to go into recession. Holy smokas, man. 85% said we were going to go into recession. And we didn't even get close. We didn't even get close. My biggest fear, by the way, I don't know if you remember, probably a lot of you remember, was a wage price spiral. I thought we were screwed because we were going to see a wage price spiral because wage growth was going up at such a rapid pace because nobody could hire anybody. So wage growth was like double digits. And the problem with that was it was well in excess of the rate of inflation, even then. And so then all of a sudden you have this situation where you go, oh my gosh, what happens in the event that you end up getting basically a situation where you get a runaway wage price spiral, and then the Federal Reserve has to pull a Paul Volcker on you. That was the big fear, that we were going to get Paul Volcker. That's it. It was that simple. And so, fortunately, that did not end up happening. Could it still happen? Probably not, because of the wage price spiral. And is the Fed going to be willing to pull off some kind of like disastrous move here just to try to, crush inflation that's a little bit above? I don't think so. I don't think the Fed wants joblessness. I will say, and this is such an interesting, and I know I'm talking so much this morning, but I just, like that whole like Rick discussion had me really interested in like, maybe I just need to be a little bit more clear in like my thinking here. But think about it for a moment. The Federal Reserve started out by suggesting, hey guys, this is going to be painful. We're going to go through, pain, maybe wait to buy real estate. These were things that they talked about. It was like, we're going to have some pain and we might have a recession. And then what did that end up turning into? It turned into, well, if we cause too much joblessness, we'll end up creating a lot of suffering, and we don't want to create suffering. How interesting, eh? That switch, the switch from, this is going to be a painful transition, and we might have to risk a recession, to, yeah, joblessness causes a lot of human suffering, and we don't want to do that. These are just, from memory quotes from Jay Powell. Obviously we could fact check all of this, but this is a Fed. This is why I say if Jerome Powell can stick a soft landing, and I'm not just saying like, for 2023, I mean like for 24 and 5, like we're not just like walking into a recession. I'm gonna build a if anybody knows how to build a statue, I'm building a statue of Jay Powell, and I will put it in my front yard if he can pull off the soft landing. Not Janet Yellen, not Trump or Biden, Jay Powell. I will be the only loser in America with a statue of a Fed chairperson. Stupid. But I love it. I don't know. We believe private credit offers an attractive opportunity today given higher yields. Interesting, because yesterday Citibank talked about getting out of private credit trading, especially the riskier sectors of private credit trading. One of the things that you see in sort of private credit markets is this idea of getting higher yield by basically, how should I say, investing in things like Affirm loans. It's one of the reasons Affirm's blowing up so much is there's actually an appetite for that in the secondary market, right? So consider that for a moment. The secondary market is like juiced over this idea that you could get these higher yields. Oh, there we go. My screenshot finally came through. Here we go. Take a look at this. This was that break-even screenshot I was trying to get to load for you. So it's right here. And you could see we were heavily under, like we were way more under 2% than we were above 2% on the 5-year break evens, right? And flexible average inflation targeting, I didn't know this, but it actually was announced like right over here. So in this sort of regime of pushing inflation expectations up, the Federal Reserve actually contributed to that. Part of the reason then was they were kind of pissed that inflation was running below 2%. At one point, they're like, should we lower the Fed funds target to inflation target to 1.75%, because we can't get it up. We're turning into Japan over here. We can't get inflation up again. In some weird, perverted way, the pandemic was a gift for solving lower than expected inflation. Isn't that weird and perverted? Yeah, probably. Like, think about that for a moment. The Fed's like, it's entirely possible that they're like, this is great. Now we can get inflation above 2% again. Oh, remember, they don't want deflation. People have this horrible misimpression, and I only feel bad because I do feel bad that I think a lot of people are going to miss out on investing in real assets like real estate or stocks because they're so convinced that the Fed is going to destroy the economy. But then we're not necessarily looking at all of the pieces of what the Fed does or tells us. Anyway, a little bit more of this. Actually, hold on. What do we have here?
PCs, which you are
I want to see this for a moment. Micron CEO, because I want to hear data center talk, and then we'll finish off with that piece.
for industrial, you're calling the bottom. How is this going to unfold?
Well, Jim, in terms of over the last 2 years, we have seen that PCs and smartphones have seen significant declines in terms of units being sold in the market year over year. And we see that in calendar year 24, PCs, smartphones, servers, they will have modest unit growth. But what's exciting is that they will all have increased content in them. AI is driving increased demand for memory in data center applications, as well as across the edge in smartphone, PCs, automotives, and various industrial applications. Along with this, customer inventories have not...
This is so boring.
PC markets, which have been large for us. Data center inventory continues to be somewhat high. We have said it will normalize in first half of calendar 24.
You know, I'm just going to take that little snippet there because I read, you know, their earnings. One of the things that I think is so interesting about the talk that we're getting from CEOs around the country, really. I mean, I'm talking like almost every single company. Almost all of them are like, oh, we expect things to be better in the first or second half of 2024. Almost all of them. And it's great. Like, don't get me wrong. I think it's freaking fantastic. So I'm excited about that. But then again, it is kind of their job to sell their stock, right? Because if you do a bad job of selling the stock as a CEO, what happens is you basically get fired by the board. So you have a responsibility to shareholders. Now, a lot of people look and go, oh, well, the CEO should only be operating for the long-term benefit of the company. But remember, folks, it's not just shareholders who benefit from higher stocks. It's employees. Stock-based comp is really important for retention, and not just retention, but also recruitment. I mean, if your stock is a dog stalking in the toilet, it's harder to recruit if people don't have faith in your stock. Tesla stock trading sideways for 3 years is not great. Fortunately, people still have the memory that, you know, Tesla can obviously do crazy things in the stock market. So I think there's hopium around that. But boy, you know, it's definitely something that's going to be if the stock trades sideways for too long, it's something that ends up weighing on employees too. Employees want to be part of growth, right? No employee wants to be part of a sinking ship. Anyway, opportunities in private equity are likely to continue to emerge. Yes, I agree with that. Real assets, in particular real estate, we see more compelling risk-adjusted return opportunities in credit than in equity at this stage. That's interesting. That's basically saying like investing in bonds, right? Like mortgage-backed securities. There might be an argument to be made there. That is interesting. Public equities are as unappealing as they have ever been, with 20 years due to stretched valuations. Well, that's interesting. Public equities, so public stocks, are as unappealing as they've ever been due to stretched valuations. You know what blows my mind, and I still have struggle reconciling this, is what happens when that money market money comes over to the stock market and things go even more kooky doopy. I don't know, man. I think could Michael Burry end up being right? Is that where you end up getting your S&P 500 bubble? Like, is the return to potentially money printing just going to set off euphoria in the stock market? I actually think so. In fact, before the last Fed meeting, before the pivot, I made a video. You could YouTube it. Meet Kevin. Here comes stock market euphoria or whatever. And I made a video talking about, I think there's a chance the Fed's about to set off stock market euphoria. And they've started to. I mean, look at what we've had the last month. And imagine when they actually start printing again. Oh my gosh, it's gonna be insane. They got to get through the repo facilities first, obviously. So we got another, 9 months-ish to go over there. So anyway, the U.S. economy has defied expectations. Yeah, we know. Okay, well, that's the end of their summary. Okay, interesting. All right, that's interesting. All right, well, you need some bears out there to have reason to be bullish. So you gotta say thank you. Can y'all in the chat give me some bear arguments here? I need some more bearishness. Keep in mind, we're live every day. The market is open on this channel. I changed the channel name to Stock Market Open since sometimes I do live breaking news on the main channel. I'm still trying to figure it all out, but my big view is how can I provide more value? And we're doing that with the Market Open live streams here, eHack, totally for free. Great value over at eHack. Oh, by the way, right before the bell opens up, I want to show you this feature. I'm not a programmer. I have no freaking idea what I'm doing, but I'm trying my best. I want to show you this. I added for stories that are kind of cool. Somebody's like, hey, Kevin, I want to be able to share your warships are en route to the Red Sea story. So what I did is I created a link to this piece button so you can copy the link. Let's see if it works. Yeah. And then you can basically, there's anchor text that's in here, and the anchor text rubber bands you right to that spot. So I've only done that for a few of them because I have to go into the HTML and kind of manually do that. And then I added a little ticker bar up here too. But anyway, I'm playing around with it. I'm trying to add where people are asking for feedback, and so it's kind of cool. It's just it reminds me of 2009 when I first created a website. Actually, it's probably closer to 2008. I think I used Apple had a paid a website thingy back then. Anyway, so it was iWeb or something they called it back then. But anyway, bond yields down at 3.838. Let's look at the 30-year mortgage, and then we've got about 2.5 minutes to go for the bell. We're looking at 30-year mortgage. I always like to go to the 740 credit score. In case you're wondering, when you type it, you could literally just Google 30-year mortgage, and then change the rate to the 740 credit score. That's generally your premium tier credit score. That's the best credit score. You can see we're at 7.04. So we're just knock right there at breaking into the sixes. Anyway, looking for some of your comments here on bearish commentary. I see a comment here about China. I agree with China. China is definitely bearish. I think their MSCI or their stock market continues to hit new 4-year lows every single day. Pretty crazy. There are reports from NVIDIA saying that workers are becoming lazy because they made so much money from StockCom. Damn. That's actually funny. I mean, that's a great recruitment tool. That's not so great for productivity. That is not what I would have expected. That is very interesting. I love that. Wow. Okay. All right. World War III. Yeah, that would be a catalyst. Car for coin, you want to send... Yeah, dude, absolutely car for coin. Look, if you want to send me news for eHack, how about this, okay? I'll make a deal. If you want to send me news for eHack, I'll put your, Twitter handle in it or whatever. I'll put it in, and then I'll put kind of my commentary in there as well, but I'll put, hey, thanks for contributing or whatever, and I'll put your Twitter handle in. Send it to kevin@ehack.com, okay? kevin@ehack.com. So yeah, absolutely, man. That'd be cool. I'm very excited, and we got the bell coming up here in a sec, about what's going to happen with the Bitcoin ETF. Mostly because I think we're going to move into some pretty exciting new ETF products that come out after that. So that'll be fun. Okay, so let's listen in here for Babel.
From him tonight. That's Todd Schneider, and you cannot have a recession if Cintas is blowing the doors out. You just can't.
Certainly fits with claims today. 205, down 10K from the prior week. Even continuing claims had a downtick.
I'm always worried that someone will say, wait a second, Cintas is doing so well, we can't cut rates. No, this is the part of the economy that is like paychecks. It has just sailed right through because these are the people who actually add employees. These companies just cut. These companies do great things.
Let's get the opening bell here and the CNBC real-time exchange of the big board. Offshore wind installation company Cadeler celebrating its listing at the NASDAQ, the Salvation Army of Greater New York.
Holy smokes, it's so freaking green, bro. Just all we needed yesterday, and we touched on that yesterday. And obviously, like, we knew the RSI was high yesterday, but we touched on it yesterday. I'm like, all we needed was to get that RSI down off of 81. The NASDAQ went down. I talked about this yesterday. I'm like, the NASDAQ RSI went way lower into like 57 range or whatever. And the S&P went to like 67. So I thought there was actually a chance that tech would outperform today. I will say, I was not expecting the NASDAQ to be up 1% at the open. I was not expecting Tesla to pop 2.4% at the open. Oh my gosh, on this lower GDP. Holy smokes. Bro, what the hell, man? I mean, I'll take it. We've had 2 years of pain, baby. I'll take it. I'll even lose money on my Costco short if we could get the rest of the market to go up. Fine. I'm like $25,000 short on Costco. And now it's at 666, which maybe that's a bad omen, but oh well. I hold my thesis that it's overvalued. I could get burned on that one. But that's okay. I'm sticking strong. That's the only short I have. But anyway, NVIDIA, what? 490 here. Enphase up 2.7%. I mean, it dropped like a rock yesterday. Coinbase up again. What's Affirm doing? Watch, Affirm's going to be blowing up again as well. I think it's so fun. Like, this is so entertaining. What do we got here? Yeah, look at that. Another 4.9% on Affirm. You did have a little bit of a reset on Affirm yesterday. That was, I think it was a negative 9% day. And that was after Jim Cramer, did the classic, we're going to the moon, which just more entertainment a factor. S&P up the 85 bips here. SPY is basically the same thing. Let's go look at some of the other moves here, and then I want to look at bond yields as we're moving up. So we've got, let's see here. Okay. There we go. So we have Redfin up 5%, Affirm 5.3, Micron 7. Chinese stocks, MSCI China actually moved up. Enphase, Etsy, all in the 2 to 3% range. Anything going down? No way, dude. The only thing down is the dollar and volatility. You gotta be kidding me, man. This is literally, it's feeling like parts of this are feeling like 2020 again. Don't get me wrong, that was a fun freaking time, okay? Like, I look back, and I worked my ass off in those days, and I feel like I work even harder today, but I don't know what it is. I feel like we always look back and we have a fond memory of the past. I don't know, man. I kind of miss it, but anyway, this, it kind of feels like you're getting a little bit of a revisit here of some of that feeling where, like, things are supposed to be so bad. It's like the child on the swing smiling while the fire's in the background. Like, things are supposed to be really bad, but they're not. They're actually, like, really good. So, kind of bizarre. And it's like, knock on wood, that continues. We did just get Caterpillar drop negative, DWAC dropped negative. Did DWAC react at all to the Colorado case? Not really. No, not really. Disney's green. We're at about 2.6 here. Tesla still 1% Qs. Enphase over here. Okay, let's go do a little bit of research while I transition to this because we've got a few pieces I want to cover. Let's listen to Jimbo for a moment.
bunch of interesting calls that I think about you when I read. Dutch Bros, Webbush, top pick, best idea today is a good example.
They've cleaned it up, and I've met with them, and I'm very proud that they managed to be able to slow down some of their willy-nilly expansion, which was really hurting them. I told them to raise capital when it was at 40. They didn't listen to me, but when it got to the mid-20s, they did. They have the capital to expand, and they have, of course, the Annihilator, the single best.
Okay, I will give credit there if Jim Cramer, because I don't remember that. I don't listen to everything he says, right? But if he indeed said, hey, raise capital when your stock is higher, I actually think that's smart. Like, I think that's the point. And we forget, we think the stock market is to make us money. The stock market is designed by virtue of the stock market to be liquidity for employees and for employees and for there we go. For the company to continue expanding and to continue growing. So when your stock is high, it's kind of like, when you're GameStop or whatever, you should take advantage of building up assets if you might need them. And a company like Dutch Bros, remember, Dutch Bros, their goal is obviously to compete with Starbucks. And in order to do that, you've got to have more locations. And I don't know what it is, but people are obsessed with Dutch Bros. Like, absolutely obsessed with Dutch Bros. Every time we go somewhere for, real estate or whatever, or we're driving around, scooting around, people are like, oh my gosh, it's the Dutch Bros. Nobody says that about Starbucks. It's always, it's Dutch Bros. There is something to be said about that sort of mentality that you have. It's a good thing. It's what it is it's brand, right? So, like I said, good thing. Okay, so, excuse me. Oh, yeah. All right. Let's take a look here. So, what do we got? Okay, so these are some international inflation numbers. Let me listen to Jimbo for a sec while I get this situated.
Guys, we spent a lot of time on Warner Brothers and Paramount. I don't want to belabor it, but it is interesting to note both stocks are down. So there's nothing the market likes here. Like the possibility that Paramount gets potentially taken out, or at least questioning what price that would be. And Warner Brothers Discovery shares are down another 3% today after a sell-off late in the day yesterday as well. Because, listen, Jim, they take on a lot of leverage here. Even if you do an all-stock deal, there's a lot of debt apparent.
All right, let's listen in here for a moment. Look at this. This is an interesting one. Chief Economist's Corner. A challenging year lies ahead. Developments in the world economy and financial markets in 2023 were fortunately much better than feared. Now, a new year awaits us, which already promises to be very challenging. Ooh, do we got potential bearish news here? I'm excited about it. As another year draws to a close, it's time to take stock and look ahead. Let's get straight to the point. 2023 turned out to be just as exciting and dramatic as foreseen a year ago, when the war in Ukraine, record high inflation, and renewed monetary policy tightening shook the foundation of the world economy. But luckily, we were spared any earth-shattering quakes. China's quick reopening, consumers' insatiable appetite for new experiences, and rapidly declining inflation, as well as a strong labor market, staved off the feared hard landing. But uncertainties loom. Most industrial sectors and countries are ailing and will, similarly to the rest of the economy, feel the impact of aggressive monetary policy tightening into 2024. Yes, totally. Like, keep that in mind. The manufacturing sector is poopy-doopy. And everybody is saying that same thing. And although inflation has dropped quickly, the main reason is the dramatic plunge in energy prices. I don't know if that's true. I mean, I know that energy prices have fallen, but let's just look. I love my little multivariate core inflation chart. When we look over here, I don't think, because we could take out energy prices, right? So if I look here and I just look at the multivariate core trend, which is the blue line that's highlighted here, or I look at the probability band, which is here, this removes energy prices. So I'm not entirely convinced that that is the case. Overall, okay. So overall, consumer prices are still 10 to 15% higher in most countries than the summer of 22. Yes. I actually usually use 18% from November of 21. Well, I guess that's fair. You get about 6 months in between there. And although wages are now increasing across the board, it'll take some time for households' purchasing power to be fully restored. That is true. You need real wages to keep growing. That's why the Fed doesn't want to destroy wages. Meanwhile, there is a risk that rising wage costs will lead to new consumer price increases. Bro, where are you getting this from? Like, I understand that's a risk, but it's not reality right now. It's just another thing that I get frustrated about it because I'm like, are these analysts who are paid to sit on Wall Street to give us like their fundamental opinions or whatever, are they not reading the earnings calls? Are they not looking at companies saying the consumer's not willing to pay anymore, and even though our costs are going up, we can't pass on higher prices, even though our wage costs are higher than they were, and in some cases still increasing, we can't raise prices? Costco's complaining about it, Ulta's complaining about it, every single company is complaining about it. We can't raise prices, we can't pass them on anymore, so we're trying to be efficient in other parts of our business. Google's looking at potentially laying off people from their AI sales team, or from their ad sales team rather, potentially because of artificial intelligence. Like, I don't get it. I don't understand. Why do these Wall Street analysts not understand when their job is sitting on Wall Street, understanding that those are potential risks? Like, to me, I feel like, well, like, you could balance that, right? You could say, hey, look, it is possible that rising wage costs lead to price increases, but so far, companies have been unable to pass along those higher prices based on, a survey of, the recent 500 freaking earnings calls. I feel like I've read 500 earnings calls this year, and I love it. I'm a reader. I like reading, mostly earnings calls because I think they're really fun, and earnings reports. I love business and everything about it. But where are you getting it from? I don't know. It frustrates. I'm just ranting. I'm starting to sound like Rick in the other direction. The so-called second round effects are the main reason why central banks have not declared victory over inflation. Bro, they're not declaring victory over inflation because the second you do, grandma's coming out with margin on her stocks and we're going to the moon on GameStop again, okay? Like, that's why they're not going to declare victory, because they know they're just going to set off euphoria. So they have to kind of imply victory. We're going to imply victory. We're not going to call victory. Just the same as the mainstream media, they all have biases. Yeah, probably true. I really do try my best also on HouseHack to make sure I remove all of those biases. So if you ever find anything biased in a green check mark, please call me out for it. My goal, just so you see it, is when we're on HouseHack, my opinion or the team's opinion is the little yellow face with the swirly, but check marks or just data, like data we're getting from, like if we're referencing a report, then that report, and then we could check the biases, obviously, of that report. But that's my goal. But anyway, okay, let's keep going here. Moreover, geopolitical tensions, which have characterized economic trends this year, have not eased. The war in Ukraine seems at a deadlock. The war between Israel and Hamas could potentially escalate. I mean, so far what I'm hearing is things could get worse. I mean, that's the case every freaking year. In terms of politics, 2024 could be a landmark year. We got presidential elections in the European European Parliament elections, and of course in the U.S. Who knows what'll happen if Donald Trump gets into the White House, or if he doesn't. Like, I think that's like almost an equal weight there, because you've got people who are nervous about what happens if Trump gets in, but then you've got people who worry about, well, what happens if he doesn't, or like what happens if he's not on the ballot. You could have civil war if he's not on the ballot. I think that's my opinion, could actually drive us the closest to some form of civil war uprising if he's not allowed on the ballot. That's why, I'm like, I don't know, man. Just let people decide. And I get it. I'm all for, judges determining, what their conclusions are in crime and stuff like that. I get it. That's their job. But, oh, man, I'm just saying, I see bad things if he's not on the ballot. And I don't care who wins. I told Lauren that. She's like, what do you mean? Well, how could you not care who wins? Because she's much more passionate than I am. I'm like, I'm just going to cover the news, Lauren. That's my job, okay? Whatever it is, I'm just going to help try to provide value with whatever the cards are. You deal the cards, and I'll play them, okay? It's a universal truth that it's difficult to predict the future. My best guess is that 2024 will be very challenging. I don't know about that. Europe on the brink of recession. I think internationally, you're right. Could be a little bit more challenging. I don't. That's it. That's all they're saying. It could be challenging because things might get worse. Oh, come on, that's boring. Well, let's get another one.
But they're also incredibly thoughtful. And I thought that Jonas's piece about what's bad news for EV is what's good news about Ford and GM is why my trust has such a big position in Ford, because they are the ICE machine.
And that extends to suppliers as well, I would assume?
Yes, yes. Mag does a lot of this stuff. But I think that what people have to recognize with Ford is that they're the hybrid company. And hybrid is where people are making...
Hybrid company? They're not the hybrid company, bro. You know who the hybrid company is? The hybrid company is BYD. BYD is the hybrid company, not Ford. Okay, so let's take a look at here. We've got our favorite bears. Oops, wrong button. Our favorite bears right here. T.S. Lombard, 2023 in review. The year that wasn't. 10 things that didn't happen. Hey, we were just talking about that. There was no recession. Heading into 2023 with an inverted yield curve and 425 bips of tightening behind us. Real rates restrictive. Consensus shifted to 70-ish% chance of recession. By some counts, it was as high as 85%, which I referenced earlier. And here you can see it jumped as high as 100% at one point. However, the economy was more resilient. Unemployment didn't need to rise for inflation to come down. The immaculate disinflation. Central banks didn't cut. That's also true. Yeah, because we didn't go into recession. Inflation decelerating, unemployment at all-time lows. We didn't get a 6.5% Bank of England terminal rate. Bank of Japan didn't raise interest rates. There was no banking crisis. Well, I mean, they turned the money printer on so fast. Remember, I told you this earlier in this live stream. The Fed will turn on the money printer so damn fast to prevent pain. So fast. Somebody here says, Dems trying to manipulate Jerome Powell to say how well the economy is doing for the election. Energy down, job up, economy is up. So let me respond with what I believe to be a fact, but of course, because I'm saying it, it's an opinion. I believe that if the economy does well going into the election, Biden is much more likely to win. You need a bad economy for Trump to get big momentum. But if we're at rally mode, you know, people are going to pocketbook vote. Again, this is not me taking a position of like for or against Trump. It's just saying like what benefits any person who's running for an office is a poopy-doopy economy by the current leader. But yeah, the money printer was offset by offset the banking crisis. There was no U.S. government default. Oh, wow, that's true. I forgot we had that whole disaster. China didn't have a reopening boom. That's true. Not a lot of stimulus over there. They're calling it the L-shaped recovery. Oh, man. Who remembers Larry Kudlow? We're going to have a V-shaped recovery. Oh, man. Those were the days. And we did. He was right. We did. It's just then we V'd down. Well, what the stock market did. We V'd up and V'd down. Geopolitical shocks that didn't shock with Russia and Israel. Global property market didn't collapse. That's true. We had maybe 10 to 15% declines in residential real estate in certain markets. But boy, real estate is local, man. You should see LA right now. It's just blowing up. And I hate LA. So far, I've refused to touch LA. I hate LA. But anyway. Thank you so much, folks, for being here. Make sure to go to ehack.com. After the course member live stream, I'm going to dump a bunch of information on ehack.com. So check ehack.com in about 90 minutes. It's totally free. It's going to be free forever. It's just a thank you to all of you, and it also helps me just kind of consolidate all my research and what's going on in my head. I also like being able to look back at my previous calls and go, you know, it's all right there. So appreciate y'all. And let's go ahead and press the disclaimer here.
Go yourself.
This one. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. there you have it. All right, folks. There you go. We will see you on the next one. Thanks again, folks. Bye.